One of the most fundamental ways to value and compare stocks is with the PE, or price to earnings ratio. If you plan to do anything in the investing world, even if that's just speculating or watching CNBC, you're going to feel lost if you don't understand this ratio. Luckily, it's really easy. Everything you need to know coming up. Hey there, it's great to see you again. On this channel, it's my goal to help you build your rapidly growing, highly diversified net worth one video at a time. And understanding investment basics, like a company's PE ratio, is important for your long-term investment success. Because a company's share price does not in any way reflect its value, it's not helpful at all in our effort to value and compare companies or investment options. Apple, despite its $150 share price, is still worth about $150 billion more than Amazon with its $1,500 share price. The price to earnings ratio provides us a simple way to assess the value we're actually getting when we purchase one of those shares. It measures how much you're paying for every dollar of earnings. You can use it to initially gauge how similar companies in similar industry sectors compare to each other. It's made up of two variables: a company stock's price per share and a company's earnings per share, or EPS. Price per share is easy to see. It's simply the share price at which a company stock is currently trading. It's what you would have to pay to own a share yourself. EPS, on the other hand, requires a little calculation. It's the company's profit divided by the number of shares outstanding. So it's the amount of profit that could be attributed to each of those individual shares that you're considering purchasing. Kind of like you would do with any investment. I'm going to buy this house for $100,000 that is renting out for $5,000 per year. That's my earnings per house. There is obviously a lot more that goes into that, but when you're considering any investment, you want to know how much it's producing. And earnings per share gives us a quick and easy, albeit incomplete, glimpse at this. Thus, when you're comparing the price of a share to the earnings per share, in other words, when you evaluate the PE ratio, you learn how much investors are willing to pay for every dollar of earnings, or how much you would have to pay for each dollar of earnings if you were trying to buy a stock. For example, at the time of this recording, Google, or Alphabet's shares, are trading around $1,000 per share. Its net income over the last 12 months was just under $17 billion, and the total shares outstanding are about 700 million. That means they earned around $24 per share. $17 billion divided by 700 million shares. With that information, investors have been willing to pay the current $1,000 price per share. Thus, they're willing to pay around $42 price divided by EPS, or $1,000 divided by $24 for every dollar of earnings. Or you could say Google has a PE ratio of 42. You can compare that to the fact that investors are only willing to pay around $16 for every dollar of earnings from Apple, or Apple's PE ratio is 16. Netflix, a little over 200, Amazon's over 250. You might also want to use this number to compare a company to its industry or sector. The technology sector, for example, right now has an average PE ratio of just under 43. Or you could look at the market as a whole. For example, you could use the Standard & Poor's 500 as a proxy for large United States companies. Its PE ratio right now is around 25. From these numbers, it would appear investors are expecting much more future bottom line growth from Amazon than from Apple. If you have a reason to disagree, if you have a reason to believe that Apple will grow just as much or more than its competitors, perhaps you have the start of an investment thesis that Apple is undervalued and thus would make a good investment for your dollars, at least a candidate to further research and analyze and evaluate. Or, on the other hand, maybe you think investors are overestimating Amazon's future, and you have a case for its stock being overvalued. Neither one of those reflects my personal opinion. They should just serve as an example of how PE can offer a down and dirty side-by-side industry comparison, and how it could help steer the direction of your research. So depending on how you compare it, a company could appear over, under, or appropriately valued based exclusively on price to earnings ratio. But obviously there is so much more to a company than its earnings over the last 12 months. For example, as I just mentioned, this calculation in no way accounts for expected future growth, which is likely the reason Amazon consistently maintains a high ratio. On top of that, it also doesn't accurately account for a company's current financial position, considering important factors like debt and cash reserves. For that reason, many investors prefer to use a metric known as enterprise value to account for all of that information as well. Also, consider the fact that net income does not accurately account for a company's current operating performance, like the metrics EBIT or EBITDA might. If you missed either of the videos I did explaining those subjects, be sure to check them out through the links in the description right after this. Despite its shortcomings, you'll still hear PE ratios referenced all the time in the investing world. Its quick and easy calculation offers a convenient metric for initial comparison and cause for further research and analysis, which is a great way to use it. But you should stop there. Definitely do not use a company's PE ratio as the primary driver for your investment idea. Don't put money in a stock just because of its PE ratio. Try to figure out what else is going on with the company. Is there a reason for any discrepancies you may have discovered? Next time, we'll cover more comprehensive company comparison ratios that might help you with that evaluation. However you choose to use these ratios and metrics, I hope you find this information helpful on your path to building your rapidly growing, highly diversified net worth. I really do hope so, because that's my goal with this channel. So if you're new here and you want to keep moving along that path, don't forget to subscribe and click the bell. And if you found this video helpful in some way, then don't forget to like it and share it. I hope to see you in the next video. Just click on the one of these that you think would be the most helpful for you. I'll see you there. Take care.